Good morning, everyone. Thank you for joining us today. I'm Susan Seville, and I'm the Director of Sales here at FHLBank Topeka. Today, we're pleased to bring you this webinar on deposit strategies in a Fed tightening cycle. Our speakers today are Joe Kennerson and Billy Guthrie, who are with Darling Consulting Group. You may be familiar with them. They've spoken with us several times, not Billy, but Joe. I'm sure Billy did a great job too. They hail from Boston. So we're kind of getting some Boston-like weather here in the Midwest today. We're kind of enjoying it. So yeah, I'll go ahead and introduce these guys. They have long, distinguished resumes. Joe is a managing director at Darling Consulting Group, and he works directly with senior management teams on building customized balance sheet strategies to improve earnings and manage risk. He strives to be an expert in overall AL management, and he educates ALCOs in the inevitable balance of financial performance and regulatory appeasement. In 2021, he spoke at 28 industry associations, reaching nearly 3,000 bankers. He's an expert at helping bring clarity to the complex and delivers a high level of energy in his ALM presentations. We agree with that statement. Joe has been with Darling since 2005, and he's benefited from working with nearly 1,000 ALCOs throughout the country on ALM and strategic initiatives. Joe lives in Boxford, Massachusetts, with his wife and 2 daughters, and he has been an active member of Big Brothers Big Sisters. Joe is a graduate of the University of New Hampshire with a degree in finance. And Billy is also a managing director at Darling, and he also works directly with financial institution executives to validate and better understand key deposit assumptions utilized in risk models. In addition to supporting core deposit study analyses, he also educates Darling's client base on utilizing data analytics to support strategic deposit decisions through Deposits 360, which is Darling's proprietary tool. He began his career with Darling in 2008 as a financial analyst, and he is also a graduate of the University of New Hampshire with a degree in finance and management. Joe and Billy would love to take your questions today, and they would like to ask you if you would please submit them in the Q&A box. My Q&A box on my screen is along the bottom. Hopefully that's where yours is too. If not, check along the side. You can submit those throughout the day or throughout the morning, excuse me, and we'll get those answered at the end of the presentation. So just as they come into your head, go ahead and type them in there, and we'll get to them at the end. And so with that, I will go ahead and turn it over to the experts. Thank you, guys.
Nothing too hard with those questions. Thank you, Susan, and welcome again, everybody, to today's deposit session. And when we think about how quickly things have changed on the deposit side, it's almost unimaginable, right? I mean, just a few months ago, our biggest concern with deposits was trying to figure out what the heck to do with all this liquidity, right? And now here we are, and deposit pricing is just about to take off, and liquidity levels are really starting to tighten up here. And in these past few months, you think about what's happened. It's like we've had back-to-back months of 75 basis points of Fed hikes, right? We see 225 basis points of tightening in less than 5 months. We saw 225 of tightening last cycle. It took us like 3 years, right? Through July, we've seen 4 straight months of deposit reductions according to our client data, right? And now we're like, okay, we're quickly moving towards what looks to be a 3+% Fed funds world. How does that impact the landscape? So there's a lot at stake. Billy and I very excited. We're gonna share insights of as we go through this tightening cycle, hopefully give you some ideas, and we're gonna talk a lot about some analytics, share that, and forecast, and how we think this is gonna play out, and also some case studies of strategies thus far that have been working, and quite frankly, some that haven't. So obviously a big topic, we are excited, and things are moving, really fast here. Here's a look at what we've seen from the Fed thus far, and what the market is is predicting, in the futures world here. And so in the orange, the Fed moves year to date. I mean, quite frankly, it's been like an up to shock, right? And it's happened so fast that deposits are finally starting to kind of like, catch up. And we've crossed over that, it's like that line, that 2% Fed funds line, when, depositors kind of figure things out and money starts to move around, and it's happening the way we would expect, right? Public funds are pricing up, get the negotiated deals on the bigger, relationships, and you're starting to see those CD specials really move higher, right? I'm seeing it in your market, 2.25%, 2.5% CD specials inside of 2 years, right? Money market rates are starting to move higher. Okay. So the pressure is definitely building. And if you look at the blue line, the futures market is like, the market's telling us that, hey, we still got 125 basis points of tightening. Rates are up again today, right? 5 years back over 3%, 5-year treasury. So who knows? It could be more, could be less, right? But clearly, if we haven't felt the pressure on deposits yet, it feels like it's coming, right? The Fed is, they remain very hawkish in what they're doing, and they made that pivot, last meeting to be, data dependent. I think that's because they just had a lot of data points before their next Fed meeting in September. But you got all the Fed members out there, kind of shouting out about how they're not even close to being done in raising rates. And while that's happening, liquidity levels, are tightening. I mentioned that. I'm going to show you a data point on the next slide. And anecdotally, we don't really, we can't talk to a banker today and hear that their cash position is, gone down materially since the beginning of the year. Seeing more institutions flip to a net borrowing position, right? And as that happens, we're looking at it like, whoa. The spread between market rates and deposit rates have really widened out. Got to be some of the widest spreads we've seen in our careers. So this storyline is building out right in front of us today. Fed's raising rates, shrinking their balance sheet. Liquidity levels are tightening, right? You got wide spreads in market rates for deposit rates, okay? So competition will intensify. And, it's happening, right, in a lot of the markets already. Now, what makes this fun, for us geeky alco guys over here is that there are a lot of variables at play, right? This time is different. I hear that a lot. And so you talk about liquidity, changing kind of the deposit landscape a little bit, right? And so what you're looking at here, these are monthly deposit trends from our client base and our Deposits 360 module. A lot of things, almost everything we're going to show you today is all fed from our deposit analytics tool called Deposits 360. We got 250 clients that utilize it. It's pretty neat. It tracks stuff like deposit migration and attrition and new money flows, all at the relationship, level, real sharp. And so this is, kind of showing you monthly, trends. Blue is total deposits, orange is non-maturities, and gray, is CDs. So I don't have to tell you about, the historical, deposit surge that we've seen over the past 2.5 years. And so the theory there is like, hey, I've got all this liquidity, right? Why am I going to go chase after deposits with rate? Because of that. So that's playing out. That there's absolute, piece of that playing out in the industry today. However, again, you look at the last 4 months, which I mentioned, deposits are net down. July was almost flat, but still net down. Okay. And so that's starting to play with the psyche, right, of deposit pricing, today. So I know this time's different and liquidity levels are historically high, although they're getting pinched now, right? However, this is a lot more. If we're talking about this time being different, let's talk about, the inflation picture, right? The story there in the Fed. They've got one goal in mind right now, is to put it out. And so what's interesting here is that, quite frankly, most of your depositors have never lived with you, through a tightening cycle like this. And if you think about your deposit base as the industry, it's, these numbers are almost fictitious and how different the deposit mix is today. Over 50% non-maturity deposit growth since 2019. Average balances are way up, right? We're going to show you today. Commercial accounts, on average up over 40%. So these aren't necessarily bad things, but it does create in the back of our mind that potential for instability, when yield is out there to get. The deposit mix is really lopsided. Almost 90% of deposits are in, non-maturity deposits. And so risk there is that, if those 2.5 or even higher CD specials start to get cemented into the marketplace, and you got non-maturity deposit rates way down here, man, there's a big cannibalization risk. We're going to talk a lot about that, today. And then asset yields are improving, clearly, but still historically at pretty low levels. So it puts more pressure on managing the funding costs. So, and as I said earlier, there's a lot at stake here. So we hope to leave you with a couple ideas to bring back to your team, right? Because how do we plan for this competition to intensify, and what's going to be our next couple of moves, as we build out this deposit plan? That's got to be fluid, right? I mean, am I going to price across the board? If I roll out a special, how do I want to kind of construct it? Am I going to price by specific segments, right? It has to be fluid because things are moving so quickly. We've got an example, I'll steal Billy's thunder, of a Deposit 360 client that Billy's been talking the last 2 days. And they reached out to us and they rolled out a CD special, something that you would see today, middle of July. And they were tracking the activity through Deposit 360. And they noticed that, for the first couple of weeks, they had 75% cannibalization. It came to us and said, listen, I got to continue to track this thing, because if we, continue to go at that 75% cannibalization clip, I got to pull this thing off the shelf and reboot. Right. And so I think moving fast is going to be critical. Bringing clarity to your new deposit base. I mentioned, some of those statistics on how much, this deposit surge has changed things. How do we want to manage that liquidity? How are we going after that today? How are we going to pay for that? Are we willing to let some leave? Tough one. And then finally, letting data be your beacon. The good news is that you all have tremendous access to data. We only know that because everything we're going to show you today is based on data that we get from our clients, right? So how do you unlock that treasure trove? And a question I want you to think about as we go through today: are you going to be making your deposit decisions through this cycle based upon gut or what your data is telling you? Okay. So with that, I'm excited to introduce, Billy, to really kind of leverage some of the data stuff that we're seeing and some of the analytics that we have.
Thanks, Joe. And, there is no doubt it is a very challenging environment to manage the deposits today and probably in the upcoming months. And there's really no historical reference point to build off of, right? We talk about this excess surge environment that we just went through. And now the Fed has really triggered a shock rising rate environment as they fight inflation. So how do we make sense of all this? And how do we create clarity within the deposit base with all this chaos that's going on today? And I think for bankers, the best way to create clarity is by maintaining quality data sets and then leveraging data science to build more pragmatic models and forecasting tools. And I still think that there's probably too many bankers out there that when it comes to analytics, that they dismiss anything short of perfect as ineffective. And I think we all know that that's not true. And to be honest, these aren't your high performers. High performers recognize the importance of data and analytics, and they leverage that data along with their industry expertise to make better strategic decisions, especially in times like today when a high degree of uncertainty is introduced. So as bankers, how do we create better analytics, better forecasting tools? That's not really the purpose of today's webinar. Maybe we can do a follow-up on that. But I think at a high level, what we need to understand is just looking at historical averages probably isn't going to cut it. We need to go below the surface. We need to recognize and identify the key variables that drive deposit behaviors and by how much. So if we're talking about the rate side, rate behaviors, of course, we need to look at the short end of the yield curve and correlations to the short end. But we need to go beyond that. We need to also look at how does the longer end of the yield curve or margin in the shape of the yield curve impact some of our pricing decisions? How does our pricing relative to competition influence how pricing is going to move going forward? Of course, account size. We know there's different sensitivity in account size, particularly larger account sizes. Are we embedding that? Are we understanding how that plays into our numbers? And then, of course, there's a lag capacity when it comes to rate on the front end of a tightening cycle. So we want to look at lag, but lag relative to spread. At what point do market rates get above deposit rates where that band snaps and sensitivity kicks in? Now, those are really the key components that we need to understand. And some of you might step back and say, like, why would I go through all that extra effort? Why wouldn't I just keep it simple? Well, the reality is that the deposit base and the environment that they're reacting to are constantly changing. Deposit behaviors and interest rate cycles are dynamic in nature. They almost never evolve in the exact same way. So let's explore that. Let's look at some of these past tightening cycles that we've gone through. On the left-hand side, what I have is the effective Fed funds rate. And then on the right-hand side, what I have is the average non-maturity deposit rate from our industry data, leveraging Deposit 360. And what you'll notice in that tightening cycle back in 2004 to 2007, we went through a pretty consistent and aggressive rising rate environment. We saw rates go up 425 basis points over a 2-year window. So that was it was 25 basis point increase every month and a half. And what you'll notice is, even though that was a pretty aggressive rising rate environment, if you look at how the rates react, there was a lag on the front end of that cycle. That is not unique to today's liquidity levels. We always see that. I think the big question is, after that lag capacity diminishes, how much pent-up pressure is there in these deposit rates to push them higher on a go-forward basis? And that's really going to depend on what's happened to market rates. How fast have they gone up? How high have they gone up? In this case, there's a lot of pent-up pressure to continue to push rates higher on the tail end of that cycle. So how does that compare to what we saw back in 2015 to 2019? Well, obviously the magnitude of that cycle was significantly lower, about half. We only went up 225 basis points. The pace, much slower. It took us 3 years to get there. Now, of course, part of that is, there was a full year between the first and the second Fed tightening, but even on the back end of that cycle, we were only seeing 25 basis point increases every quarter. So again, you look at that rate behavior, no surprise that that lag capacity extended. But then what you'll also notice, after we got back above that lag capacity, there wasn't as much pent up pressure on deposit rates because rates didn't get that high and stay there for a long enough period of time. Now, the issue that I run into is sometimes I'll talk to a banker and they'll look at this and they'll think like something inherently changed within their deposit sensitivity. And I don't think that's true. It's more of the market dynamic, what was going on with the yield curve. So where does that bring us today? What are we looking at today? Well, if we look on the left-hand side, we can kind of look at the current tightening cycle that we're going into. Joe already mentioned, we've already seen over 200 basis point increase in a very tight window, 3-month window that we're seeing. And then we might want to build a forecast. What could potentially happen moving forward? Well, I might want to assume, what if rates go up another 125 or 150 basis points over the next few months, getting us to a Fed target rate of anywhere from 3.50 to 4%. Well, on the right-hand side, if you look at the rates within this forecast, this lag that we've seen over the first couple months, that's not a surprise to us. In fact, our models were calling for this. It was forecasting it. But we're at that inflection point, right? And we already started to see that a little bit in June, definitely starting to see it in July numbers, that pickup. Now the question is, how aggressive does that look going forward? And let's put that into perspective to these historical tightening cycles. If you look at the Fed funds on the left-hand side, no doubt the front end of this cycle is significantly faster than even the 2004 to 2000 cycle. And then if we look at what's going on rates on the right-hand side, that starts where we are. We've only seen this uptick up to this point on rates. But what we're forecasting over the next 2 quarters is that deposit rates are most likely going to start moving up faster than they have in over 15 years. So are we prepared to manage our deposit base in that type of environment? Where do we want to, or where do we need to price relative to competition if and when that comes to fruition? So we want to take a deeper dive into some of these pricing trends. This, again, leveraging our industry data, it's a rate matrix, right? So breaking out all these different deposit products, looking at average rates, looking at the rate changes that we're seeing, and then also breaking that out by different percentiles, right? And this is as of July, so a little bit of lag in the data. But what you're definitely starting to see over the last quarter within this data is there's been some pockets of higher rate sensitivity that are definitely emerging, right? On the money market side, you see some of those highest tiers, they've already gone up on average 25 to 30 basis points. So that really speaks to the importance of understanding how account size drives sensitivity within your institution. It also speaks to the fact that, hey, let's think about our tiering structures. Are we building in the appropriate flexibility within those? That's something that Joe will hit on. You think about CDs. If you look at the belly of the CD curve, those rates on average are going up 60 to 110 basis points. And that's the average of the total CDs, new offerings that are going on. That's not just isolating promotional products, right? So that curve, the belly of that curve has definitely spiked up. The other thing, what you're starting to see is that rate difference, that spread between average rates and the highest percentiles is really widening out, right? You're starting to see a lot more options or incentives from some of your customers to go out and get better yielding products. So how are we going to manage that? How are we going to continue to manage this as this continues to build up in the upcoming months? The other thing is I want to break down some of these pricing trends in a little bit more detail. Let's also look at money market, but not just money market average portfolio rates. What's the rate of the cost to acquire? So what's the average rate of the new accounts that are coming on within the money market portfolio? Then again, let's break that down by different percentiles to understand that, because it's very important. We know there's a wide range of pricing, and that's also going to be dependent on what your strategy is, what your liquidity needs, the different dynamics of your own marketplace. It's important to understand that. I think we also need to think about that relative to how we set up product structures, where we want to be priced. And if we look at some of this data on the money market side, you're definitely starting to see over the last couple months, right, some of the largest percentiles picking up. But these still are nowhere near where they were back in 2018 when the short-term market rates were at similar levels. We haven't got that high, right? So to me, I can step back and say, I don't know, maybe there's opportunities on the money market savings side to, maybe be attractive at a lower pricing point today if I want to make an aggressive move there. But the other thing we also have to think about is, where do we want? Are we trying to do a retention play on our existing customers, or are we trying to drive new volume? We were working with an institution that they were looking to drive new growth. So they actually went with a product that was above 1% a month or two ago. So it was very attractive, the top end of their marketplace. But because they were so attractive there, that allows them to put in some hurdles, right? To add some barriers to that product that limit some of that cannibalization. So they were talking about things like new money components, and that worked out very successfully. But I think you also have to consider, make sure you understand what your goal is in the range of pricing that you need to accomplish your goal. We can do the same thing on one-year CD rates. So if we look at one-year CDs, we break out those different percentiles and we look at that behavior. And one thing I think that's going to jump out on the screen is, over the last couple of months, CD rates have jumped up much more aggressively than the money market. Money market's still lagging a bit, but you definitely see a correction in some of these CD rates. But again, even though they're spiked up, they're still not to the levels that we saw back in 2018. So there's probably a potential that they're going to continue to work their way back here. And this is looking at some of the largest percentiles, but what you're starting to see is like the top 1 percentile, right, of these offerings. You can see some 3 handles on some of these short-term CDs. So I think we really need to think through some of these pricing trends. Going back to the example that Joe talked about, talking with an institution the other day, and they rolled out a promotion. But the issue was they didn't really figure out before rolling out the promotion what the goal was. They didn't really understand or decide whether it was a retention play or a new money or growth play. And they actually went up to the top end of their market with that pricing with no barriers. And the result was, that's very attractive for everyone that's rolling their CDs. They saw cannibalization over 75%. And the cannibalization was coming from lower rate CDs and a lot of money markets at a weighted average rate of 40 basis points. So the marginal cost of bringing in net new money in that promotion was significant. It was over 6%. They probably would have been better off going to the FHLB to bring in those funds. But because they had Deposit 360, they were able to recognize that very quickly. So the conversation then became, hey, do we kind of shelf this product for now and then come up with more of a retention play on CDs that's higher than what they're currently priced, but not at the top end of the market? So you get a benefit for some of that retention. And then if you still want to be aggressive, if you want to go to the top end of the market, get comfortable with putting in a barrier like new money. Now that institution, they'd never done a new money. So they weren't perfectly comfortable with that, but that's something that they're going to go back to their team and discuss the pros and cons of that. The other thing outside of pricing, the big uncertainty that we have is on the volume side. What is going to happen with balances as we move forward? And what's interesting is if you look back before the pandemic if we looked at annual growth rates within total deposits, depending on the environment, you're going anywhere from 4 to 10% annually. So let's call it 7% on average. And then what you'd see is obviously when rates rose, you'd see a little bit of a shift out of non-maturity deposits into CDs. But overall, over the last few decades, CD balances, portfolios have been contracting. But it's very difficult to tell whether that's like a demographic change or just a lack of interest in CDs, or is it just the fact that there's been very few windows where there's been an incentive to go out and lock up funds. Started a little bit back in 2005 to 2007, and then very, very briefly back in 2018 to 2019. So that's going to be interesting to see how that plays out as rates continue to rise. But if we look at post-pandemic or through the pandemic, non-maturity deposits went from a mix of 75% all the way up to 88%, almost 90% on average, as Joe mentioned earlier. But this isn't just migration out of portfolios or migrations out of CDs. This was the fact that we had all of these stimulus funds being pumped into checking and savings accounts. This is untested funds that we have never managed through a tightening cycle. So I understand that that creates some anxiety, some fear about the volatility within those balances. But I think there's a lot of people that are stepping back and saying there's also a unique opportunity that's there. I can build my deposit franchise. I can expand my market share, maybe even steal some market share. So we need to think about how we're going to manage those balances going forward. And how much balances am I willing to let run out before I pull that rate lever? And that kind of goes into how do we want to manage or forecast balances? If you think about balances, there's a couple of key drivers or variables we should be looking at. Of course, there's pricing, but there's pricing relative to market, and there's market alternatives, as well as pricing relative to competition. Those are both going to drive growth in volume. There's also other things. There's like vintage, account age, there's the size of the account. But the other big wild card today is surge, like the big what's going to happen with those. And I think when we think about balance, one thing that I hear a lot on the rate side is a lot of bankers have been asked going into this tightening cycle, like, do I think deposit rate sensitivity has changed? And I hear a lot of bankers answer that question with, yes, I think deposit sensitivity is lower because of all of this excess liquidity I have. I have a big issue with that not because I disagree with that notion. I think if you have excess liquidity, you should build that into your pricing decisions. My issue is that that's not the question that's been asked, is as your depositor sensitivity change. I would make the argument that because of these elevated account balances, there could be more sensitivity. Your depositor has no loyalty to your liquidity position. So as more incentives to leave arise, they will exercise their option to move those funds. You just need to decide how much you're willing to let that balance change. Then on the surge side, what we tend to see is about 20 to 25% of excess growth held in non-maturity deposit portfolios today. Up to this point, they've remained pretty stable. Like year to date, we've only seen about 5% of that surge kind of leaving those institutions, but we need to build that into some of our forecasting. So this is an example of 3 different scenarios. The blue line represents a base case. So this is a base case as of July. So July market rates remain intact for that simulation. What you're noticing is it is forecasting a little bit of growth, but it's very difficult or more difficult than it was to grow because competition has picked up. And then if you add on to that, if we go another 125 basis points, and then again, we still maintain this excess growth, it's going to put some downward pressure on these growth levels. But the big question is this surge. And this is an exaggerated example, right? So this is what if rates go up another 125, 150, and 50% or about half of that surge exits, right? What you'll notice in that example, it's a significant amount of pressure down on deposits. Now, I was working with a client last week. They were trying to develop their budget, right? And what they were looking at is they're like, oh, well, we expect rates maybe to go up, to 350, 4% range, but then what if they come down, right? But even if they come down, they're not really going to come down significantly. So we were kind of looking at the base case scenario and an up 125 for them as the mid range. And then they also wanted to build in what if 25% of the surge runs out. And what they found running those numbers through their forecast is they still grow, but at a very muted pace, and they needed to grow. So that started to push some decisions about, hey, now is the time for us to get a little bit more aggressive on the pricing side. And I think it all goes back to this liquidity or forecasting out, get a better understanding of what could happen with balances to really make some of those decisions. And it's all going to come back to doing your homework, right? Getting into the details. I recently got asked a question about, do I see a standard or a typical average behavior on surge as it relates to different asset sizes? And I don't think that's the right question. It's all going to be dependent on who your customers are, how you hold those customers. So we talk about average balances being up. We look at average account size on business on the left-hand side. You can see they've gone up 43% since the end of 2019. But a lot of that was a spike up back in April 2020 associated with the PPP program. And yeah, they've continued to trickle up, but they've kind of flattened out. We have a lot of excess funds that came in 2020 on the business side that are just sitting idle today. On the retail side, yeah, you saw about 36% growth over that time frame. It was more of a gradual increase in 2020, and then you saw that pop up. No surprise, that's like kind of that second consumer surge as we had larger stimulus checks go out. So I really want to explore that. This is a case study from an institution we worked with a couple of weeks ago, and we're asking everyone to go through this exercise. And what we did is we broke out their total amount of growth following the pandemic, and then we also wanted to break out different business lines or different segments of that. We wanted to look at business, retail, public. And then we also wanted to take that additional step. We wanted to break out different relationship sizes, right? We know that those can behave differently. And this is actually a pretty common breakout. They saw a pretty even mix in business versus retail over that period of time. But if you look at how that business and retail balances were held, it's much different, right? In this example, they saw about 50% of their balances in business in some of the largest business accounts. They were holding it in less than 2% of their relationships. So there's a concentration risk there, definitely. But this also gave them an opportunity. We talked to them about reaching out, having individual conversations with some of these largest businesses, understand the cash needs and deposit needs of those businesses, because that's going to give you intel on what's going to happen to your funding need, right? On the retail side, you're seeing it kind of more consistently across some of the different tiering structures. So you can't necessarily handle all of those on a one-on-one. So we talk about establishing macro level attrition monitoring, right? So can we have systems set up where we can identify the largest declines in the retail on a period by period basis or consecutive declines over time, and then get in front of some of that attrition? But I think the good thing on the retail side is because it is a little bit kind of evenly matched between some of those different tier sizes, even if like spending and savings trends change, maybe it'll be a slower bleed versus something that happens overnight. But I think we also have to step back and think about this as it relates to pricing, right? If you think about the business side, I want to make sure that I'm breaking out operational deposits from discretionary and potentially pricing those or pricing those differently. But I think we also have to go an extra step today. We also have to say discretionary, and then discretionary that was never intended to be held in the deposit portfolio. I don't want to be chasing those with rate if I'm never going to retain them. So on the business side, maybe there's reverse tiering or some sort of cap on the pricing. On the retail side, what we're seeing is a lot of these high tiering structures are overweighted on their top tier. So can we better manage that? Again, Joe is going to talk about that. But the biggest takeaway is that we're seeing 75 to 80% of the excess growth from the pandemic at your typical institution being held in a small portion of your relationships. So let's get a better understanding of who they are. Another risk factor that I think we need to be aware of, we need to get in front of, is how much CDs do we just have sitting idle within our non-maturity deposit portfolios today? And if we look at the industry level, what we see is the 2 years following the pandemic, CD portfolios declined on average about 22%. But if we look at relationship level data, build up all the accounts into one unique depositor, what we find is about half of that contraction was actual loss of liquidity. It was customers removing their funds from those institutions, presumably bringing that back to their core banking relationship. But the other half simply migrated within those banks into the non-maturity deposit portfolio, with a lot of those sitting in the money market portfolio. So do you not only know the magnitude, how much funds you had shifted into your non-maturity deposit base, but where? And then what's the plan? How do we plan to retain them? Do we plan on retaining them? Do we want to keep them in those non-maturity deposits, or are we going to purposely shift them back in to CDs? And then again, what's going to be the cost of doing that? When it comes to CDs, the other trend that we're looking at, we want to kind of start to look at what's happening to CDs at maturity. And we can start to break out looking at, how many of them are rolling over to the same account in blue. Then we can also look at migration, or how much are rolling into another account within that institution in orange. Then we can actually look at how much are exiting the institution at maturity. That's the gray, that's the attrition. And one thing that you'll note is that rollover to the same account is going down. So we're seeing more activity, people taking better rate alternatives within the institution, or actually what we're seeing quite a bit too is the attrition. The loss of liquidity is definitely spiking up within this period of time. So do we need to start to react? And I think a lot of people look at this loss of liquidity that we're now experiencing and say, hey, maybe I got to do something more aggressive on the CD side. But I think we also need to step back and think about what type of relationships are we bringing in when we do these promotions. There's this idea, a lot of people talk about either doing relationship-based pricing where you need to have a checking account to get those highest rates. Other people look at it and say, hey, I'll attract with the high rate and then I'll backfill. Then I'll onboard those accounts and cross-sell. Why is that so important? When we look at industry data and we segment out the single account CD relationships versus the multiple account relationships, at maturity, what you tend to see is single account relationships have 2 or 3 to 4 times higher loss. So if you're not executing on cross-selling into these CD relationships, especially after you bring in these promotions, please understand at least what you're getting into. These are more sensitive customers, right? So we talk about some of these overall trends on the pricing and the volume side. Now what Joe's going to expand on is like, how do we tactically want to roll out some of these increases to pricing and promotions, and then walk you through some case studies. So Joe, take it away.
Thanks, Billy. So when Billy and I are having these deposit strategy sessions, with our clients, and we're talking about how we want to be positioned, how aggressive with pricing, the conversation inevitably comes back to liquidity needs, right? And what's the picture look like? And that's tough to do today, but it's critical in forming these strategies. Give you a couple examples. I got one client that they're at a pretty big net borrowing position with the home loan bank here, right? But they're still pretty defensive with their deposit strategy, right? They built up a big investment book, right? It's generating a lot of investment cash flow, and they want to right size their asset mix, moving forward. And so they're looking at, kind of the pipeline expectations on the lending side, and looking, at the investment cash flow, say, I only need to grow, deposits 2% over the next, year or so, right? So it's not like they're not raising rates, but they're just a little bit more kind of, pointed on where they're pricing up, and they'll backfill on the home loan bank. I've got, another client that, their loan demand won't quit. Right. And so we need to be a little bit more aggressive out there and find pockets of opportunities. Taking a page out of Billy's book, we actually crafted up a money market special and went out there where nobody else was really competing, right? And kind of focus on that growth in order to minimize cannibalization. So it's going to help kind of shape, how aggressive or defensive we want to be. When we talk about defensive strategies, we're talking about growing from within, protecting what we have, critical today, right? Negotiated deals, man, that's where it's all happening, right? You can't even trust those rate sheets or the websites and where they're posting deposit rates out there today. I feel like everything's happening in the back office there. But like, what are the tactics as we deal with negotiated pricing from some of these larger depositors, right? Are we just matching, right? Matching term and rate? Probably not a lot of us, but how are we doing that? And I love seeing, our clients that have what we call these shelf products, something that's already kind of predefined, built out, it's got a name, right? But it's not out there to the public, right? It's positioned for a specific kind of segment or deposit base. And I also like that the shelf products today on the money market side, right? Especially as these, calls are going to be coming in. So I get 2%, I get 2.25%, I get 2.5% on a CD special, really making the depositor have that tough decision of, is it liquidity or yield, right? What if I give you 95 basis points on a money market product, right? Have more control over the cost structure there. I've got one client, they've got like a couple of tiers of money market shelf products based upon the overall relationship. And then I've seen even like more offensive plays on this, identifying kind of like that, critical, customer base, something that could be at risk, and seeing more and more institutions that are kind of going after this ahead of time, right? So, and simple example would be looking at CDs coming due with lower coupons and trying to attack those, as we know competition is going to continue to get tougher a few months from now. But even looking at different segments of where you've seen the biggest growth in average balances on some of these large relationships that have fully fully kind of full relationships with us, and how do we maybe price accordingly for them rather than pricing across the board. I'll give some examples. Revisit balance tiers. That might be the simplest takeaway, maybe the most cost-effective, takeaway for today. I'm working with 5 clients on that project right now. And then core checking initiatives. Obviously, we're always trying to core checking accounts, right? But like thinking about this once in a lifetime opportunity that we've all had, where we serviced a lot of accounts, that others didn't, right? And how well have we really harvested and built those relationships? I'm talking about on the PPP side. Now, those of us in the growth, side of things, Billy showed you the data. Okay. If you're looking to really grow net deposits this year, it's going to be a challenge, right? And, notwithstanding going into new markets and all that stuff, but it's going to be a challenge. And if the strategy is to go out there with just a run of the mill, CD special with $1,000 minimum balance, that might not be the most, cost effective. So what would a new product look like? Where's nobody else playing, and then as we kind of, start to, craft these promotions, really think about how we can minimize deposit cannibalization. Okay. Because one of the biggest risks to margin, right, over the next year or so is going to be deposit cannibalization. Right. And so how can we differentiate this product set, right? And really focus, and then how do we track? We just gave you the example, of a client, the past couple of days, really tracking, the migration and the true marginal cost on these new specials. If that's going to be critical, especially if things continue to tighten up. And then on the CD side, obviously CDs are a smaller book, but that game is changing, right? And so on specials, we talk about establishing guardrails, on protecting against some of the cannibalizations, simple stuff that I'll show you a couple of examples of today, and where we want to be positioned on the curve, right? You see a lot of CD curves today that make sense. They're inverted, right? Highest rate instead of 24 months. I probably would be a little bit cautious. I saw one yesterday, talked to a client, a 3%, CD special out long. I'm like, man, given how inverted the yield curve is today, I'd probably be a little bit tighter than that. And then I'll kind of get into some things on, looking at some at-risk, deposit base, and also maybe some liquidity plays on going after, some old CD, customers. But let's focus, initially here on the money market side. I mentioned, revisiting tiers, and, because we're going to be in a situation, you probably already are, where, you're considering raising up your money market rates. And I'm kind of working on, this project with 5 clients right now, which is really revisiting the tier structure, especially if you have a more legacy, tier structure. Let me kind of explain what I'm talking about here. What you're looking at, this is our client data, right, from money market accounts broken out in pretty granular tiers. But what I boxed in here, you can see is that 85% of all money market balances for our clients are in accounts that are over 100,000, right? So, you tend to see this frequently where, looking at rate sheets, the top tier today is 100,000 plus, right? And of course, the challenge there is, you can see it from the data here, right? The biggest moves thus far have been on the highest tiers, right? It's where we move the quickest and the most. And if we're doing that, it's going to have the most, or I should say the biggest impact on cost of funds starting right away. So in this particular example, if we look like this, like we don't really have a tiered product, right? We do, but we don't. Right. And so talking about how do we smooth out some of these tiers, and it's going to give us more, pricing flexibility. I just did this for a client out in, up in Wisconsin, actually. Restructured all their tiers. They've already saved $60,000 in their first couple of rate movements that they've made, just by kind of balancing this thing out. This is also a healthy exercise to really understand where your concentrations are. If you're thinking about doing a shelf product or rolling out a new product, you gain some really nice intel on your deposit base. Okay. I also mentioned how we're seeing more institutions price kind of more on a segmented basis, right? Rather than kind of move rates, all across the curve, you're trying to find where those, those true pockets of at-risk depositors are. This is a case study. Okay. This is an example from our Deposit 360 module. And what you're looking at are average balance trends by different cohorts. Okay. Over to the left is the $1 million+ cohort. And over to the right is 250K accounts to $1 million accounts. And you can clearly see, I didn't have to make a line here. You can see that the post-COVID inflection point, right? Where in this case, almost 60% growth in average balances in these large relationships. And so, I had one client that went through this, and they looked at some of the biggest increases in average balances, both on the business and the consumer side, and then kind of dove a little bit deeper in understanding the relationships, and actually identified 1,700 depositors that they actually put a campaign together, knowing that competition is going to start to heat up and start to kind of, maybe lock into some, specific product mix, which is pretty interesting. So what's the story underneath the hood of how these deposits, and these relationships are really, kind of built out? So this is a continuation of that case study through our segmentation analysis. And you can see in the top middle here, I've highlighted all the accounts over 250,000, right? And then starting to get a sense of, okay, what do these relationships look like, right? How long have they been banking with me? How old are they? Are they business versus consumer? Where are they located? Like the top left one here, number of accounts in a relationship, right? In other words, who are the single source customers, right? And who are the more well-developed deposit relationships? So, there are an infinite amount of ways that you can go about, developing strategies here, market specific, a couple of ideas here that I've been hearing about, one, strengthening, building on some of those single source, relationships. I have a personal example for this. I've got about, 4 or 5 different, institutions that I bank with, right? I've got my mortgage over here. I don't do any other type of deposit relationship. I got an email 2 weeks ago from a relationship manager, right? Asking how they can, really, develop our total banking relationship. I'm like, okay, that's cool. I'm like, I'm on this side of the call usually, so I wanted to hear the pitch, right? And kind of looking at their deposit mix and their rate mix. And they didn't have a deposit rate over 20 basis points. Got them on the phone. Guess what? They had a new money CD special at 2% for folks like me. They might win my relationship. So, interesting kind of like boots on the ground type of stuff to fight off some of those liquidity pressures. Also, what we want to protect, of course, are these real, strong, developed core relationships. And, I say front run sensitivity risk. It's just because we hear from clients like, hey, this competition is likely to get, Billy showed all the trend analyses, right? Likely to get a little bit more intense. Do we do something now to kind of get ahead of this and to show that we're moving the needle on some of these relationships? Inevitably, we're going to start raising rates across the board, right? It's just going to happen. Okay. Then the question becomes how much and how am I willing to let this thing play out? Am I willing to let some bleed off and use the home loan bank as my backstop? Here's a marginal cost of funds as example. Okay. This is for a client. I had an outcome meeting a couple months ago with them, a premium money market account. I rounded out the numbers for today, 150 million, current rate, 20 basis points. So they're well behind, right? They're kind of liking it, right? We haven't moved rates yet. We probably should. And so went through a hypothetical example here, said, okay, what if I raise rates 50 bips? Right. I should have done that already, according to, what my deposit beta, suggests, right? If I go 50 basis points, first, let's get some data on that, right? Going up 50 basis points increases my interest expense starting day one. And in this case, about $750,000 of annual impact. And then I like this last data point too. And I think this is important for everybody, right, in the ALCO meeting to hear, especially on the lending side. It's like, well, I need $30 million of growth at a 2.5% spread just to cover that, right? And so it comes back to what's the liquidity picture look like? But coming back to the pricing discussion, saying, okay, well, if I don't raise rates, as Billy said, I'm going to sacrifice volume. It's going to happen. This particular client, they've done some deep analytics on the deposit side here. A couple of things. Number one, they noticed that their average balances on money markets are up 40%. Okay? They also noticed that they've had $43 million of CDs shift into money markets that are sitting idle. So they're kind of like, well, it doesn't matter if I raise rates 50 basis points. It's still inevitable that I'm going to lose some balances. Right. And so let's have that discussion. So kind of going through this exercise. Well, what if I lose 15%? In this case, about $23 million, which is, almost a little bit more than half of what, shifted out of CDs. It's like, well, if I don't raise rates 50 basis points, okay, and I stay at 20 bips and I lose 15%, well, guess what? 353 is my break even. Right. So the math tells me I can go to the home loan bank, roll funding short, right, and still be better off from an expense standpoint. Right. And so I know that's not how it plays out in reality. And so you're going to have to move, some versus how much are we willing to let go? What does the data tell us that might leave anyway? Right. And that's kind of the purpose of going through this exercise to really carve out that deposit plan. We talk about, maybe the, opportunity, and this door is closing, right? To get, to get some good growth, potential it seems to still, exist on the money market side, right? Because if you want to make a splash on the CD side today, you're probably going to be 2.25, maybe even higher, right? And then it's like, that catches up, soon. And the money market side is still kind of waking up a little bit. Here's a live example, right? From one of our clients, in Deposits 360 that rolled out a premium money market account early, right? And so this data is, going, end of April to the end of July. So this is very up to date, right? Rolled out the CD or money market special at 1.25. And if you go to the bottom right here, you can see, over 3 months, they brought in $71 million of growth at a rate of 124. Now, focus in on those two numbers because that's what we see on the balance sheet. And that's when we start to ask the question, well, where did that growth come from? Right? Where did that growth come from? That's we're all going to be asking those questions. That's exactly what we're capturing here in Deposits 360. So if you go over to the left here, green represents, new money. Right. And we're looking at in two different buckets. The first one, new relationships. This is what we want. New depositors coming in, how much they bring with them. Existing plus would be depositors that already had a relationship with us, brought in more money, right? The blue bar is what we're all going to want to wrap our arms around in this cycle, which is the cannibalization. So in this case, again, $71 million of growth, 38% of that were just recycled funds, right? I think we need to get a little bit deeper than that as well. Right? It doesn't tell the whole story. In this case, well, most of the cannibalization came from legacy money markets. They were going to shift over anyways. And actually the rate differential wasn't all that much. So the marginal cost on the new money earned based on that cannibalization was just a smidge higher, right, than our offering rate. Absolute home run. So the question is then, what makes this different? How are we rolling it out? What are the barriers to entry? Right? And not to be negative there, but what's in it for us? What's in it for the depositor? Right. In this case, it wrapped in with a checking account and it had a small new money component. Right. And so what is that? Again, talking about the balance tiers, right? Relationship-based pricing. We all want to be there. How well can we roll that stuff out? New money can be a polarizing topic, right? New money only is a tough spin unless you're going to a new market. We've seen some really successful new money components as you're seeing here, which is a new money, new money minimum. So switching gears over to the CD side, Billy talked about some of the shifts out of CDs into non-maturity deposits, and I think there's some specific strategies that we can tackle there. This is an individual case study. These are CD trends. The gray is balanced. The black line is rate paid. Okay, and so this institution is like many, right, where CDs have gone down on a net basis, every month, post COVID, right, and they've seen. CDs went from 855 million to 600 million. They lost, $250 million in CDs. So a couple of things, right? Number one, in this case, well, we didn't lose. There wasn't all lost liquidity. In this case, we captured that over 90 million, again, is sitting idle in non-maturity deposit products. Right? You would guess that these are going to be the first to move. Probably ready, probably looking around already. Right? So say you got like, I still got like a 175 CD special, man, it would be nice to kind of lock them in, 15 months, into that product today. Some specific campaigns that you can do there. If you're starting to feel some of the liquidity pinch, we've seen some clients do some interesting comeback campaigns. We see these data points a lot where a lot of the CD reductions are from folks that are still banking with you. They still have a banking relationship with you, just took the CD, liquidity elsewhere. It's like, okay, well, again, if I've got something that I think is, pretty flashy today, maybe I work on, kind of like watch lists, right? Or campaign lists and start to build that liquidity up. The point is, we're trying to, get as much data as we can to be more proactive, right? And less reactive in a situation like this. So this is another live case study of a CD special, similar to the one we were talking about earlier, but it's a different one that has been hit pretty hard. Okay. So this is a 19-month CD special, rates, high ones, let's call it 2%. Okay. Active through June and July. You can see a ton of growth, $209 million. Again, bottom right here, $209 million at a rate of 194. But just look at the bar graphs over to the left. I don't have to walk through the details, right? 2/3 of all the growth in the CD product were just cannibalized. And again, we got to look at the details because it's almost like an understanding that we are going to have the existing CD base, shift into the new product. That's almost like the price of doing business today. In this case, almost 50% of that cannibalization, however, came from non-maturity products. Okay. And you look at that marginal cost on the new money earned, right? This is why we talk about, developing, guardrails and being a little bit more protective on some of these offerings, right? And the point here is not to like eliminate cannibalization. That's impossible. 250 deposits, 360 clients. I don't think we've seen a special with 0%, not even below 20% cannibalization. The point is, are we tracking it? Are we monitoring it? And how do we avoid 65% and maybe get closer to 45%, right? Or something like this. So again, another, live, case study of a CD special, very similar, 15-month, 2%, similar structure, different market. Okay, similar structure. This had, I think this was new money only, which I think is a tough play, but I've seen, you're seeing a lot out there that are new money components. Maybe they're behind the scenes. Some are right out there, right? But I think new money components, you can just look at the difference, right? In the overall results and the marginal cost in the two. I mean, you're talking big dollars here and significant differences in the marginal cost, right? On the new money earned, right? So how are we, building these things out? How are we thinking about, ways to minimize cannibalization? Because the CD pricing pressure is likely to continue. That's what the data would tell you, right? This is a different play on kind of some of the things that Billy walked through earlier, but this is just a simple analysis that's looking at, 1-year FHLB rates versus 1-year CD, rates that hit the books. And so you can see in the last cycle, when things really started to turn in 18 and 19, the spread between the two is about 100 basis points. Well, although pressure is starting to mount today, you can see how much of a spread there is. If you look over to the right, it's a lot wider. So, the pressure is gonna, is likely to continue. So again, coming back to how are we tracking this stuff, right? And how do we minimize cannibalization? This was an example we had for a client that, they said, all right, well, we're gonna do a CD special at 2%, right? But if we're gonna do 2%, why don't we just go after it, right? And be the highest out there and go 2.5%. Right? What is the true cost of funds, right? And, what's that cannibalization risk? So if you look here, that in this example, 2%, over to the top left in terms of offering rate, the weighted average rate on the potential conversion, funds are 50 basis points. So this is a combination of CDs coming due and non-mature deposits. So higher than most, but that was just their deposit mix, right? And our thought is like, okay, you're probably going to see, 50% cannibalization. In other words, if you brought in $20 million and 10 of it is new, it's likely to see, another conversion of 10 million shifting out of 50 basis points. So in this case, like, okay, if we see that type of trend, the marginal cost of new money is 350. And that, depending on, again, liquidity needs, that might be okay. The game changes. The game changes, as the CD pricing pressures really start to mount, right? And you can see if the 250s start to kind of creep in over the next, month or so, how much is it really going to cost us? Based upon that conversion. Am I better, being a little bit more crafty? And if I'm sacrificing a little bit of growth, that's where, economically, I might be better off backfilling at the home loan bank. Okay. So, I'm trying to catch my breath over here. Our thought was to, provide a lot of different case studies and data analytics and kind of our vision of what our data and our quants are telling us on what could happen. Clearly, things are moving fast. Hopefully, we'll give you some ideas, to help kind of, boost your plan and really use data as your beacon. As we said earlier, everything, we said today and we learn is just from the data that we collect and analyze and talk from all of our clients, about. So, if you folks would be interested in kicking around what Deposit 360 can do for the team and how it works, feel free to give me a shout or visit our website. So with that, Susan, we got 1 minute to spare.
Good job. Good job. Wrapping it up there at the end. Well, we do have a couple of questions. So that have been entered in that Q&A box. And so if you have questions that you have thought of as these gentlemen have been speaking today, go ahead and throw them in there, and we're going to pose those to them and have them help us get some answers to them. So with that, we'll start here. So the first question we have is a CD special that says you can use existing funds. So a CD special that says you can use existing funds, but you must also bring 10,000 of new money to get the special. Is that a good tactic to avoid cannibalization?
Yeah, good question. In other words, is 10K high enough, right? It's still going to see a lot of cannibalization. And what we have learned, and you'd like to hear your thoughts, is that it's it's a lot more effective, and it drives down that marginal cost of funds a lot more than a CD special without that component, right? And so, I mean, whether it's 10, 25 seems to be the number now. You know, I think 10 was at like 18 and 9. I see a lot of 25. You know, another way of doing it, I don't see this a lot, but I think this is another way to kind of, you know, present it, is having a match. You know, you can shift over 50,000, but you have to bring in 50,000. You know, so I think it's absolutely going to help, and it's better than I think the alternative, which is, you know, no guardrail. One thing that I think we didn't mention today that is absolutely critical is how you talk about this in the front lines, right? How well seasoned, trained, and educated the frontline folks are, because I've seen a couple of institutions get into pickle, right? That didn't have the right, you know, kind of sales tactics in dealing with this. Like you know, you can envision somebody coming in, it's like, well, I've got all my banking relationships, I don't have an extra $10,000 to bring over, right? And so how do you respond? And also, how do you create the rules of exceptions? You know, there are always going to be exceptions, if this, then that. So I think spending some time and doing some education, you know, for the frontline folks, because they've never lived through a cycle like this either, I think is critical.
Yeah, I agree. I like the idea of, you know, a new money minimum, right, that you can go. And then to Joe's point, where is the right level for what that minimum threshold is? To some extent, it's going to depend on the type of customer that you have. Like if you're typically smaller retail customer shop, and that's like kind of who you're targeting for some of those, maybe 10 is the right feel. But if you have some higher wealth or larger customers, like obviously that's a lower kind of threshold for them to go. So then you have to kind of think about it on your target, like what would that potentially mean of that shift over? And I like the mix. I think, you know, minimum new money minimums on CDs seem to work well, just because I think naturally there's a cap to what a customer will hold or put in excess, the give up that they'll get. And then I know there's for new money, the match play, I think that works pretty well on like money markets and savings, right? Because, you know, obviously if there's a minimum, right, threshold, well, people are probably more willing to put in a lot more excess into money markets and savings, that they have that liquidity. So if you put in the match, right, you naturally create a cap where the most that you're getting is hopefully 50% cannibalization. Hopefully it's lower.
Thank you guys for that answer. We have another question here that's come in. Can you give us your thoughts on doing a matching fund for a CD promo?
Yeah, I mean, I think either way, like structuring it with having some sort of barrier where you're generating, at least minimizing that cannibalization, and because you think about this whole idea of cannibalization, it's managing both sides of this. It's all relative to how much new money you're bringing in. So you have to make sure whatever the barriers are you have and the pricing is still going to be attractive enough to bring in and generate new activity. And then the barriers are how much of that you're limiting within your existing base. So again, I tend to see more minimums on the CD side, because there is that natural cap to what people will extend out there. But I guess you could also do a matching and try that out as well.
Great, thank you. I have one other question. We'll see if we get any more here. So if we go into a recession, how do you all think that that's going to affect deposit pricing and volumes?
Yeah, I mean, if we think about this, I actually had this conversation with a client the other day, and it's, you know, we're not trying to, we don't want to over speculate on what's going to happen. We have to think about things as a range of potential outcomes. But if you use the Fed funds futures, right, as a baseline, and we're talking about rates potentially going up another 100, 150, right? And then even if you look at kind of what that's calling for later next year, it's not like some of these past, or potentially wouldn't be like some of these past recessions that we've seen, right? Where these were dramatic events where rates really kind of dropped down to a floor level. We started to see like a normal easing back in 2019, and then the pandemic hit and that spiked down. At least what that Fed fund is calling for is more of a gradual bringing down rates, where they still stay, you know, above 2%, you know, around 3, you know, 250 to 3. So that's still kind of higher than the levels that we're coming from. So even if it doesn't drive rates up as high, if rates stay elevated, I still think there's going to be some pent up pressure, or competition will stay elevated, that deposits will gradually start to cycle into that higher rate environment.
Thank you. Well, we do not have any more questions listed. I'm sure people will think of things after the close today. So we'd love to answer any questions you have. I know Joe and Billy would as well. You have their contact information here. You know how to reach out to the Home Loan Bank. We'd all be happy to talk with you about any of the concepts that were presented today. Thank you guys very much for all the
Susan?
information. Yes.
We just had another question
Oh,
pop up.
thank you. I see that, Kyle. So Kyle is asking, any comments on managing exception pricing on deposits more generally? What % of your clientele engage in exception pricing for certain relationships? And how do you think about that relative to advertised tiers?
Yeah, that's a good question. I don't know how much specific insight we have in percentage of clients that actually get into the details of this, but I made a couple of comments earlier where I am seeing, some of our clients be more forward with their, exception pricing. In other words, it seems a little bit different than late, or I should say mid 2018 cycle, where, they're starting to go out, right, to the customer base rather than wait for them to come in, right? Because it's just the thought of like, we've had the shock, rates haven't moved, they're big spreads. And so again, maybe I should find, what is it about these depositors that I think could start to move. I've got another client that did something interesting. They noticed that, when they looked at their business account trends, they saw some, pretty sizable increases in deposit balances for like some of their small to mid-sized businesses. And that one's a tricky one. It's like probably a lot of PPP money sitting there. Like, how is that going to play out? And I remember the chief banking officer said, Joe, I don't know really what to do there, but I tell you what we're going to do is that we're going to pick up the phone and we're going to call all of them, solidify our relationship, talk about their business plans and so on and so forth, so that when things come around, right, hopefully we get the phone call first. And I'm like, you know what? Simple and probably very effective.
Yeah, I think those are great points. And then not on the exception price, but I do want to go back to kind of that, the piece on the potential recession, right? I think that does emphasize one of the points that Joe mentioned earlier, that it does caution against kind of overextending on some of these specials if rates don't continue to spike up and they do kind of level out or come down. So I did want to make sure I kind of mentioned that piece on that question.
The recording is still on. You saved yourself.
Okay. Looks like there really are no other questions now. So once again, reach out if you guys have any questions. And before we close, I would like to say we would really love to hear your feedback. We really do use the feedback you provide us to think about other topics for webinars or potentially alter the way we do things. We want it to fit what you want. And so we have placed a very, very quick survey. It's very short in the chat box. And we would really appreciate it if you would just take a couple minutes before you close out to take the survey. At the end of the survey, there will be another link that will take you to CPE credits. And so that's how you'll get your CPE credits. I'll also say that we will be sending the slides out to all people that attended today. So have no worries, you'll be getting the slides. We have a question about, will you receive a recording of today's webinar? Susan can correct me if I'm wrong, but I believe we do not send the recording out. I believe we store it on our website and give access to it. So give me a thumbs up, Susan, or if that's correct, or I think that's right. So But Chuck, if that's not correct, we'll get back to you. Yep. Okay. Susan says that's correct. So it will be stored on our website and you'll be able to access it there. So I know that I would like to go back and listen again and pick up on some more points that these guys said. So I didn't take good enough notes as we were going through. So thank you again, Joe and Billy. Really, really appreciate your expertise today. And thank you for everyone for attending. And I hope everyone got something that they can take back and use today. We'll see you next time.
Thank you, everyone. See ya.
Thank you. Appreciate it.